Welcome to Macro Monday on Investec Focus Radio SA, a podcast about what's driving global and local markets. I'm Chris Holdsworth, Chief Investment Strategist at Investec Wealth and Investment. Every Monday morning, I'll update you on key developments from the past week and what you need to know about the week ahead. If you'd prefer to watch a video with the graphs and charts I referred to in the podcast, just go to investec.com/Macro Monday. This week, we're going to provide a review of the latest meeting from our Global Investment Strategy Group. We'll also have a look at the employment situation in the US, the risk of a hike from the Bank of Japan, and we'll look at the latest data coming out of South Africa too. We're going to start off with the latest from our GISG, our Global Investment Strategy Group. This is a committee that's been running since 2011. It's populated by 9 investment professionals from our UK, Switzerland, Indian, and South African offices. And the purpose of that committee is to come up with a view on global risk, ranging from -3 to +3. -3 would indicate that we're very risk off, +3 indicating that we're very risk on, 0 indicating neutral. And at the moment, we are at -0.5, indicating a mildly risk off position, equivalent to being mildly underweight equity risk globally. And there were several factors that went into that decision. I'm just going to highlight a couple of them now. The starting point is that growth globally is still looking pretty good, much better than had been expected 6 months ago. If you look at the current consensus forecast for global growth, it's running at 3% for this year, 2.9% for next year. Both of those are pretty much in line with what we've seen over the past couple of years. So no material slowdown in growth expected at all. If you look at forecasts for US growth in particular, the consensus forecast is for the US economy to grow this year by 1.9%. 6 months ago, there was a 1.5%. So a pretty sizable upgrade in growth expectations for the US over the past 6 months. And if you look at some high-frequency estimates for the US that suggest that the US economy is growing at close to 4% in Q3. And it's a strong growth in the US that's been very helpful for corporates, and it's part of the reason why US companies have seen revenue surprise by as much on the upside as it has, and why earnings has been so strong in the latest quarter. So growth, little reason for concern at this point. But there are other reasons for concern, and one of those is the US deficit. The deficit this year is still very large. Debt to GDP as a starting point is above 100%, and we are worried about the outlook over the coming year. We expect that concerns around the deficit are likely to see a combination of dollar weakness and higher long bond yields in the US over the coming couple of years. And we've seen a bit of that already post-Liberation Day when the dollar did weaken and yields picked up as well. And given the concerning outlook for the deficit, we think that's likely to be repeated. There are also concerns around the tariffs. Should the tariffs be ruled illegal, will they have to be refunded? And that should add pressure to the deficit if it is the case that that pans out. But in addition, even if the US government tries to find another way to raise revenue, it's not clear at all that the revenue raised from the tariffs will be sufficient to offset increased expenditure in other ways and reduce taxation. So the net result is that we are concerned around the US deficit at this point and the outlook for the debt to GDP trajectory too. And in that sort of environment, one would like a margin of safety, and it's just not evident at this point for US equities. The US market is trading on a forward PE of about 23, which is just above 25% above the 20-year average. So there's little margin of safety based on valuation, and that just makes us a little concerned at this point. And given that the US market is close to 70% of the developed market index, and it's so stretched, we're remaining risk off at this point. High valuation by itself is not necessarily an issue. For example, if you look at Japan, which is also trading at a premium from a forward PE perspective, there we've got the extra optionality from a very weak Japanese yen, which could well strengthen. And in addition, we're seeing large amounts of stimulus applied for the Japanese economy, which could boost growth by 1 to 1.5% per annum over the next 2 years. So in that case, one could argue for a justified premium. In the US, it's a bit more difficult to do that at the moment. And taking all these factors into consideration, along with a few others, GISG has kept its risk score at -0.5. Looking at some of the other data that came out last week, key amongst them was the employment report in the US, and employment did pick up. The non-farm payrolls series picked up by 119,000 in September. This was a delayed report because of the shutdown in the US. So the data is a bit delayed, but if you look at the 3-month average, which is the key series we look at, is an indication of labor growth. That did tick up a bit, but it still is just above 60,000 per month, which is not very high by recent standards. And if in fact you look at the consensus forecast for the next 4 quarters, it's not looking very good at all. Now, the non-farm payrolls print will come out for October, but it's going to be delayed. And the current consensus forecast is that job growth in Q4 is likely to be pretty weak. The fact that that report is going to be delayed is significant because it's going to come out after the next FOMC meeting. So the Fed is going to have a tough time. They're going to have to try to gauge where the employment situation is and where the inflation situation is, while both of those delayed reports will come out after the next FOMC meeting. So they're going to be flying blind at the next meeting. The market at this point is pricing in about a 60% chance of a cut. That might be a bit optimistic given the current economic backdrop. Anyhow, back to that labor report, there were two concerning aspects to it. The first is that the prior 2 months were revised down. Again, we've now seen 8 consecutive months of downward revisions to the labor data. And it just means that we don't quite have a handle on what's going on by looking at the latest data. You've got to wait a couple of months to see where the data point settles. And that, of course, makes life difficult for the Fed. And the unemployment rate ticked up too. It was a little bit above the consensus forecast, but not at the sort of level that would be very worrying by itself. So it's more the direction of travel, the fact that the unemployment rate does appear to be deteriorating a little bit. It does make life difficult for the Fed. If you look at total employment growth, it's running at just below 1%. That's pretty low by historical standards, and there are leading indicators that suggest that the employment growth in the US is likely to slow further over the coming few months. And again, that takes us back to the Fed. The market is pricing 3 cuts over the coming year. Again, that seems pretty optimistic, and we spoke already about December. The market expectation of a 60% chance for a cut in December seems optimistic, especially when you consider the Fed minutes that came out last week, where the Fed expressed concern around inflation that's proving to be sticky, simultaneous concern around the employment situation, but finding it difficult to balance those two risks in the absence of information. Finally, on the US, we've seen an update for consumer sentiment. Consumer sentiment deteriorated again, according to the University of Michigan survey. And what's interesting is that it deteriorated across party lines. Typically, consumer sentiment is quite partisan. When a president joins from a particular party, people associated with that party tend to have a higher sentiment. And what's interesting now is even people associating themselves with Republicans in the US have seen a deterioration in consumer sentiment. So again, that's just reason for concern in the back of our minds. It does appear to be that there's some issues brewing in the US. It's just not quite fully reflected in the market in our view. Finally, from Japan, we saw a few updates that came through last week. We saw an indication that growth is deteriorating. GDP growth came out a negative, well below the plus 2% we saw in the quarter before. It was a bit above expectations, but negative nonetheless. And that's going to make life a bit difficult for the BOJ that was looking for a point to hike. What's also making life difficult for the BOJ is that inflation is proving to be sticky and well above the 2% target. And in the background, we also saw an announcement last week of stimulus, and it's fairly sizable. The plan is for the stimulus to boost GDP growth by 1.5% per annum over the next 3 years. Now, typically, in a stimulus package of that sort of scale would see higher inflation, and the ultimate effect might be self-defeating. It might spur the BOJ into hiking. At the moment, the market expects a hike by April, but given the differing moving parts here, we may well land up with one sooner than that. And we know that hikes from the BOJ are typically not very helpful for global equities at all. And finally, in South Africa, we saw a few data points come out last week. South African inflation ticked up to 3.7%. That was a bit below expectations, but nonetheless, it was an uptick, and we do expect that inflation is going to continue to drift up and will get to a bit above 4% by March before it starts to decline again. So we are going to go through this patch over the next few months. It is our base case that SA inflation is going to pick up and it's going to be above the SARB's target for a couple of months. Even so, the SARB did cut last week. It's very helpful that there's a band around the 3% target now of 1% either side, and the introduction of the 3% target should be gradual. It allowed them sufficient space for a cut now. They're probably going to be unlikely to rush to cut going forward, and given that inflation is going to be elevated for the next 2 months. But once inflation settles at 3%, on the assumption it does, there's going to be ample scope for further cuts, given that real rates in South Africa are still very high. So we could be looking at 100 to 150 basis points worth of cuts. It's just not going to be front-loaded. It's going to be gradual, over the coming year to year and a half, which should provide a pretty strong tailwind for the SA economy. And speaking of tailwinds for the SA economy, we've seen a very sizable reduction in the cost of borrowing for the South African government. This has come about as a result of an improving fiscal position, of lower inflation expectations, and improvements at SOEs. All of it together has seen a reduction in perceptions of risk in South Africa, and as a result of that, the 10-year bond for the South African government now has moved from over 12% to 8.5%, materially reducing the cost of borrowing for the South African government, but in addition reducing the cost of capital for South African corporates. And as inflation continues to drift down and settle at 3%, we expect that there's scope for further reduction too. So this should provide a pretty meaningful tailwind for the SA economy and SA corporates should it persist, and we'll provide an update over the next few months. And that's where we're going to end it for this week.
That's all for this episode. Do tune in next week for more investment insights from me, Chris Holdsworth, and the Investec Wealth and Investment team. If you haven't yet added us to your podcast feed, you can subscribe to Investec Focus Radio SA wherever you listen. And please take a minute to rate our podcast so we can surface this content to the broader investment community. If you want to see the graphs that I reference in the podcast, you can watch a video version of this recording at investec.com/Macro Monday.
The views expressed are those of the contributors at the time of publication and do not necessarily represent the views of Investec Wealth and Investment International and should not be taken as advice, guidance, or recommendation. Investec Wealth and Investment International, a member of the JSE Equity, Equity Derivatives, Currency Derivatives, Bond Derivatives, and Interest Rate Derivatives markets, an authorized financial services provider and a registered credit provider.